What is going on, my friends? It's great to see you. My name is Ryan Williams, back with another one, and in today's video, I'm going to be sharing with you 3 essential stock picking rules that you should abide by to increase your chances of success as an investor. The guidelines that we'll be covering today should help ensure that you are choosing the right kind of companies to invest in, and should help you mitigate some risk in the process as well, which makes for a good night's sleep. And before we get rocking and rolling, please don't forget to hit the thumbs up on this video. By doing so, you'd be tremendously helping me get this video pushed out to other people here on YouTube, helping me to further grow this channel. It really does make a huge difference. All right, guys, thank you so much for doing that. And now, without further ado, let's get into it. All right, guys, so first things first, rule number 1, when it comes to your portfolio as a whole, you should have it set up so that it is reasonably diverse. This might seem like common sense, but it is really not uncommon to see people either holding too few stocks in their portfolio, being under-diversified, or the inverse of that, holding too many stocks in their portfolio, being way over-diversified, both of which are not ideal for their own reasons, which we'll cover. And elaborating on under-diversification first, if you have too few stocks in your portfolio, you might not be well protected enough in the event that something were to, knock on wood, happen to any of your stocks. And I'll paint a picture for you guys real quick that should hopefully help explain this a little bit better. Now, I've put together this little sample portfolio for this demonstration right here, guys. And as you can see, this portfolio has like 5 different stocks. And, let's say this is your portfolio, and in here you're holding Apple, Tesla, Lowe's, Starbucks, Coca-Cola, all pretty reputable, recognizable companies, ones that we'd probably look at as being fairly secure. I mean, with the exception of Tesla, maybe we're gonna have to see how that one plays out. But nonetheless, as you can see by looking at this right here, you're pretty heavily weighted in a few of these companies. I mean, your Tesla's like 30% of your portfolio, Lowe's is almost 25% of your portfolio. And theoretically, if something were to happen to one of these stocks, I mean, there goes a huge chunk of your portfolio. I mean, even if your Tesla goes down like 50%, there's 15% or so of your portfolio gone. Now, the only way that you might be able to get away with holding this few amount of stocks in your portfolio is if you had some ETFs in here, by which you'd be investing in a ton of different companies at once just by that one ETF, which would create some more diversification for you to help mitigate that risk. Now, on the other hand, having too many stocks in your portfolio, being over diversified, can also be problematic, and I'll show you another example of what I'm talking about. Now, this sample portfolio has like over 30 companies in it and is very diverse, and there are a couple reasons why that may be an issue. First of all, if you have too many stocks in your portfolio, if you're too over diversified like what you see here, it's going to be harder for you to build stronger positions in the companies that you own. Let's say, for example, you're investing like $100 a month. If you're trying to put that $100 a month into all 30 plus of these stocks, you're going to be spreading yourself very thin. It's going to be hard for you to take that $100 and try and invest it into all 30, 35, 40 different stocks that you own. You're going to find it very hard to have a ton of shares in any of those companies. The second reason that having too many stocks in your portfolio or being too over-diversified could be an issue is simply because it's a lot to keep up with. As you guys know, the world is ever-changing, and so are the companies that operate within it. And as far as the stock market goes, there's always stock news, there's always stuff going on that you can keep up with. And it may just be a lot on your plate to have to deal with, especially when you guys have so many other things going on in your lives, I'm sure. And if you're like me, if you're just a retail investor, someone who's trying to build up your portfolio and generate some passive income, it may seem more trouble than it's worth to have so many stocks to try and keep track of. Hopefully this makes sense to you guys, and if not, feel free to leave me a comment below. But now with all of this said, it begs the question, what is the right amount of diversification to have in your portfolio? The rule that I would follow, guys, is to try and keep a happy medium between the 2 examples that we discussed. Specifically, guys, a reasonable amount of diversification for your portfolio is probably somewhere between maybe 10 stocks on the low end and 30 on the high end. If you have less money to invest every single month, then maybe stick to that lower end. Maybe stick closer to holding 10, 12 stocks in your portfolio. And as you begin to invest more over time, you can scale up the number of holdings that you have in your portfolio. Maybe get up to 15, 20, and kind of build it from there. All right, guys, now moving on to the second essential stock picking rule of the day. This one is a little bit more straightforward and will help ensure that you're investing in more stable, properly financed companies. Now, it wouldn't be a video of mine if we didn't at least mention dividends once. So for this rule number 2, all of the companies that you invest in should have a solid history of paying out dividends. And more specifically, you should be looking for companies that have at least 10 years of consecutive dividend payments. Now, admittedly, guys, I've broken this rule myself by investing into Owl Rock Capital Corporation, ticker symbol ORCC, which only has 1 year of dividend payments under its belt. But, you know, it's a newer company. It's only been around for a few years, so I guess that's how I'll have to justify my deviance. Anyway, guys, by adhering to this rule, rule number 2, you are essentially eliminating the possibility of owning what we refer to as growth stocks, which in my mind are companies that don't pay a dividend at all, but offer a benefit to shareholders by the way of increases in share price. Now, having said that, guys, don't think that by following this rule you are greatly limiting your choices for stock investments. There are still plenty of great dividend-paying companies out there that will fit this criteria. In fact, you could even set a rule for yourself not to invest in companies with less than 20 years of consecutive payments, and you would still have a large amount of companies to invest in. At any rate, guys, by following rule number 2, you are helping to lessen the risk of your investments because only a company with a good head on its shoulders can offer this amount of consistent dividend payments. And a few examples of some really great companies that you can still invest in by adhering to this rule would be, first of all, Coca-Cola, which has a continuous record of 58 years of dividend payments. Starbucks, which just barely makes the cut with 10 years of consistent consecutive dividend payments. And lastly, Procter & Gamble, which has a whopping 64 years of consecutive dividend payments. All right, guys, now let's talk about rule number 3, which arguably may be the most important rule of them all, and that is simply don't speculate. Now, there is a difference between investing in stocks and speculating, which is something I would like to cover on a future video, but the key difference just comes down to doing your research. Now, this is something that a lot of newer investors maybe don't want to do, which I don't blame you, or maybe they don't know how to do. But frankly, guys, when considering putting your money into any stock, it's going to be important for you to know what you're getting into, and that includes knowing who this company is and what they do, along with knowing how financially healthy the company is and how it has performed for its shareholders over time. By having an understanding of all these things, you'll be able to know both if it's a good investment to add to your portfolio, and if so, why. Unfortunately, guys, when it comes to your own portfolio and managing your own money, this is stuff that nobody else can tell you. And at the end of the day, it's bad practice to buy or sell a stock solely based on someone else's recommendation, especially if they don't provide any reasoning behind it. Now, if your plan is to be a long-term investor, it will be well worth your while to take the time and start to learn a little bit about this stuff, know how it works, so you can take control of your own finances and set yourself up for success. Now, I'm not saying don't take any suggestions from other people who maybe have know of a hot stock or know of a good investment. I'm simply saying that you should just do your own research to figure out if and why it's something that's worth investing in for you. All right, my friends, well, those are the 3 stock picking rules I have for you today. I hope you learned something from watching this and are able to start implementing these rules into your own investing strategy. Obviously, if you guys have any questions on anything that we covered today, please feel free to leave me a comment below. I would be happy to address them for you. Also, let me know which rules you think will make the biggest difference in your investing strategy. For me, I'd say it's probably the first one on diversification, and also probably the third one on speculating. Both of these are things I've had to learn the hard way. All right, guys, well, I will now get out of your hair. Thank you so much for watching. I hope you guys enjoy the rest of your day, and I will see you in the next one.